Did you know that out of everybody that's under 22 years old, 3 out of 10 people don't have a bank account? I know, right? And then out of those 3 people, at least one of them doesn't know what a bank account is, which is like super scary. Today, we're gonna be talking about the most important differences between a checking account and a savings account. Hey guys, I'm Esther. Welcome to Adulting with Esther, the channel where we talk about the things that you don't learn in school. Today, we're going to be talking about the important differences between a checking account and a savings account. And then if you've made some mistakes because you didn't know the difference, we're going to be talking about how to fix those expensive mistakes. If you're new here, I'd like to invite you to press that like button. It raises us up on the search engine so more people can find these videos. And if you're not subscribed, go ahead and press that button down below and press that alarm symbol after you click that red button so that you'll be alerted when we post new videos. Today, we're going to be talking about the 2 key differences between a checking account and a savings account. The 2 key differences that we'll be discussing today are going to be the purpose and allowable actions of each, and then how they're impacted by interest. And then, if you hang around till the end of the video, I'll also be sharing with you how you can remove some of those pesky fees or expensive mistakes that you've made for free. So the first difference, the purpose of each account is very different. Banks have named them differently because they expect them to do different things. A checking account, you'll have checks, you'll be able to cash checks. If you have a job, you can sign up for direct deposit, which means your employer will send your check, your paycheck, for your work done directly to your bank, and you will no longer have to receive a check in the mail. However, if you do receive a check in the mail, you can easily go to an ATM or physically go into a bank or even submit it via the app online and take a picture of your check to deposit it into your checking account. A checking account also allows you to withdraw money. You can withdraw money from your checking account via an ATM or a branch, or you can even transfer it online. Overall, the purpose of a checking account is mostly transactional. It's so that you can put money in there and be able to take it out of your bank account when you need to with things like a debit card or a check or a withdrawal slip from your bank. The purpose of a savings account is a little bit different. It's made to hold and grow your money. With that being the intention, getting money in and out of a savings account isn't quite as easy. When you put money in, you'll typically, if you want to withdraw it, you'll have to go into your savings branch and fill out a withdrawal slip. You might be able to access your savings account through your ATM and be able to withdraw money there. Something you definitely can't do, though, is withdraw money from your savings account using your debit card. It will only come out of your checking account. Same thing when you're writing a check. You cannot write a check to take money out of your savings account. You'll have to go online or physically go into your branch and transfer your money from your savings account to your checking account. Difference number 2, interest. Now, like we talked about in step 1, the purpose of a savings account is for you to grow and hold your money, while the purpose of a checking account is to be more transactional. The bank wants to incentivize you to use a savings account. And here's why. Banks make their money from loans. Loans for homes, starting small businesses, credit cards, and otherwise. When they want to lend money out to other people to go on these endeavors with their loans, they need to get the money from somewhere. Well, they get it from you. When you put your money in a savings account, luckily it's insured up to $250,000 through the FDIC. And you'll see a little logo on your bank that looks like this when you know that it's insured. And that's because of the Great Depression in 1929. And if you want to know more, you can go ahead and Google it. But here's what happens. The bank sees that you've left your money in there, and because of that, now they're going to share it with other people. You're guaranteed to have it back, up to $250,000 worth, but they're going to use your money to give someone else a loan or a mortgage or a credit card. Now, when they're using that money, they're charging someone else interest, somewhere between 3 and 25% interest if you're looking at a credit card. The bank is going to make a lot of money off of that person who is paying that mortgage, loan, or credit card interest. And you're over here wondering, well, why don't I get anything? Well, you do. By having a savings account with your bank, they're going to give you a very small piece of interest for leaving your money in your savings account and allowing them to use it to fund other loans and investments. Now, here's where the bummer is, though. That interest they give you is not very much. it's typically 0.01%, which means if you had $100 in a savings account, over 1 month of that interest rate, you would get 1 penny. Now, this interest rate is better than the one you would receive from a checking account. And that's because in a checking account, you don't get any interest at all. So far we've talked about the two big differences with checking and savings accounts. One is made to hold your money, and they try to incentivize you by using interest to keep your money in there. The other one is made so you can easily access your money and get it where you need to via your app, via the computer, via online access, or your bank or your ATM. Now, you hung around till the end, and I promised you that I'd give you that extra information on how to remove those nasty expenses and what you need to look out for. If you found value out of this video so far, go ahead and press that like button. Keep us in business. Now you need to be aware of some of the pesky fees that banks try and hit you with. They're in the business of money to make money. They want to help you, but not that much. The first thing you can do is make sure that you know whether or not your checking or savings account has a fee associated with it. Many banks will actually charge you a monthly fee of $5 just to have an account with them. Luckily, this is a fee that you can avoid using multiple tactics. One, if you are a student in college or high school, you can typically show your student ID and they'll give you a free account. Heads up, once you're no longer in college anymore, don't advertise it to the bank. You'll typically be able to have that free account for an extended period of time. Typically, if you set up direct deposit from your employer to your banking account, they will allow you to waive that fee. Because again, you're keeping a constant amount of capital in that bank, and the bank will be able to use that money for their loans and mortgages and otherwise. The other thing you need to be aware of with your bank is overdraft fees. Overdraft fees are very dangerous and can get you in a world of trouble. So let's say you have your checking account and you remember that it has $150 in there. And so you go to the store and you spend $150 on your debit card and you feel good about everything. But later that night, you log back in and you realize that you only had $115 in your bank account. You've actually withdrawn more than you had in your checking account. And when you do that, you have taken more than you have, and so you've overdrafted. When this happens, your bank will typically send you an email or call you right away because now you've incurred an overdraft fee. Overdraft fees can start as little as $35 and go up to $50 or more. Overdraft fees can be really dangerous too. Multiple banks have different ways with how they handle them. Some banks will only charge you an overdraft fee one time. One offense, one charge, that's it. Other banks will charge you an overdraft fee every single day that you haven't fixed it. So when you see that your bank account is short, make sure you fill up those negative funds right away. Typically, you can solve that by a transfer from your savings into your checking account. And you can actually set that up to be done automatically with a thing called Overdraft Protection. You can easily call or look on your bank's website for more information about that. The last way that overdraft fees can be dangerous is if you make that transaction and then you make another transaction that takes you further into the negative, you could incur a second overdraft fee. So make sure you always know how much money is in your account and set up all those bank alerts so that you know when your account balance is running low. So let's say you get some of these fees in your account and you're worried, what do? I wasn't prepared for this. How do I solve this? It's really easy. Go ahead and pick up your phone and call your bank and explain the situation to them. Here's something that I typically say when I call them.
Hi, my name is Esther, and I have an account with you. And I'm sure you can see on there that in my checking account, I made an overdraft. Do you see that? Yeah, I know. It's really unfortunate. But one thing that you can know about me is that I have had a very positive track history with you guys. I have never overdrafted before, and I'm sure if you look back on my history, you can see that. You're able to see that? Great. Well, because of that, and I'm typically very good with my money, what happened here was that an auto pay on my account came out sooner than it should have. I was wondering, since this is my first offense, if you'd be able to refund that overdraft fee since I've already replenished those missing funds within my account. Oh, you can? Great, thank you so much.
It's that easy. And heads up, I've done that more than one time, and I still call and I say the same thing, and they still refund those funds back into my account. So never be afraid to call your bank and ask. Now, before you go out there and open a bank account or decide that I need to get my money out of this bank account because I'm not making any money there, I want to encourage you to do some Googling about high interest savings account or high yield savings accounts. These are accounts that are based primarily online, but they provide you with interest that is a lot higher. The one major negative about these high yield savings accounts, though, is limited withdrawals per month. Typically, it's 6 withdrawals in 1 month. If you make more than those withdrawals, you will get impacted by a heavy fee. However, these high yield savings accounts can have interest as high as 2 and 3% if you find the correct one. So my advice to you would be, when you're saving up for things like your emergency fund, or if you have a goal that you want to reach within the next 1 to 2 years, and you know that you need that money to be there when you need it, I'd suggest you look into a high yield savings account. As far as the savings account that you have with your local bank, you can use that to where you deposit your check and then maybe budget your money from there. And your checking account, make sure that you have that set up to your phone so that you can keep tabs on how much money you have in there and do your best to avoid any of those pesky overdraft fees. And remember, if any of this ever goes wrong, you can always call and they usually will understand and help you out. I hope these tips were valuable today and gave you some insight about the differences that are really important for you to understand between checking and savings accounts. If you like this video, go ahead and press that like button and then click subscribe down below so you can be alerted when we post our next video. Thanks for stopping by.